Want to save some money? This is what you need to know if you have a current VA loan and you want to refinance, or you just want to take some money out and have some extra cash. Okay, so let's get into this real quick. The most common is the VA IRRRL, right? That's a fancy way of saying streamlined refinance. This is the interest rate reduction refinance loan. Okay, you are reducing your interest rate. Maybe you're at 7% and you're going to go down to 6% or 5% or whatever it is. Okay, this is what the requirements are. Guess what? It's a lot easier than when you bought the house. There is no appraisal required. It's streamlined. We're going to reuse your current VA entitlement. This does not change the entitlement that's charged on your COE, your certificate of eligibility. And if you're in a 30-year fixed, which is the most common, if you're moving from one 30-year fixed to another 30-year fixed refinance loan, the rate must decrease by 0.5%. So if you're at 7%, you got to go down to at least 6.5%, hopefully even further. And if you're in a fixed and you're moving to an ARM, the rate has to decrease by 2%. Those aren't as common. Most people are in a 30-year fixed when they do a VA loan. So you got to go down at least 0.5%. And this is non-income qualifying. So we're not qualifying income. We're not qualifying assets. We're not ordering an appraisal. It is extremely streamlined. You're going to fly through the underwriting process and get into that new loan. Okay. So also, here's when I say seasoning, that's a fancy way of saying waiting time. Okay. If you started a VA loan, you have to wait at least 210 days from your first payment date, and you'd have to make 6 monthly payments. Okay, so if you say you purchased a home, it's December 2023 right now. Say you purchased a home last month in November, you can't do a VA IRRRL this month, even though rates have come down. You got to wait at least 210 days after your first payment, and you have to have made 6 payments. And then there's another common question. Say you bought a home, I don't know, 2 years ago as your primary home, and you've moved on, and now it's a rental property, now it's an investment property. Yes, you can VA IRRRL a home with a VA loan that's on an investment property. Absolutely, okay? Absolutely, it's super strong. When we talk about cash outs, I don't want to get too confusing, but there's type 1 and type 2. But type 2 is the most common. You can pay off any lien with a VA cash out on your home, all right? So you have to have some type of lien, whether most common is the current mortgage, but if there's for some reason there's another lien on it, we can pay that off. Technically, anything is a cash out in the VA world if it's not an IRRRL. Like in the conventional world, you have rate and term and cash outs. So if you're not just refinancing your interest rate, it's technically a cash out in the same seasoning as an IRRRL. And here's the cool part. You can go 100% loan to value on a VA cash out. So if your home is worth $400,000, you can have a loan amount of $400,000. Now, there has to be net tangible benefits. There's a few of them, but these are the two big ones. If the interest rate is lower, say you're at a 6.5 and you're doing a cash out to 6%, that is the net tangible benefit. You can go up to 100%. There might be lender overlays, but the VA lets you goes up to 100% loan to value. If you're staying at a 90% loan to value, so say the home is worth $300,000 and the new loan is going to be $270,000, well then that's a 90% loan to value. Doesn't matter what the old interest rate and the new interest rate is, the net tangible benefit is you're staying at 90% loan to value. So in this case, let's pretend your current mortgage was $200,000 left on it and you're taking out a new loan at $270,000, well you're going to, cash out the difference. So I wanted to talk about VA refinances. They're going to start becoming a lot more popular as rates are starting to decline. Reach out if you have any questions.